Imagine deliberately swallowing a massive financial loss, completely on purpose, just to protect your relationship with your customers. Like,
Yeah.
you have the power to raise prices and save your quarterly profit margin, but you look at the board and say, no, let's just take the hit ourselves.
I mean, it goes against every instinct in modern corporate finance. Most companies will, immediately pass any new expense directly down to the consumer the second it hits their balance sheet.
Right.
But deciding to absorb that pain requires a massive amount of confidence. You have to really believe that playing the long game will eventually pay off.
And that strategic gamble, that's exactly the core of our deep dive today. We are unpacking the Q1 2026 earnings report and the conference call from Bassett Furniture Industries. Ticker symbol is BSET, if you're looking it up.
Yeah, they're a 124-year-old American home furnishings brand, which is wild to think about.
It really is. And our mission today is to decode how a legacy company like that handles a brutal, chaotic macroeconomic landscape. It's basically the ultimate real-world business case study of trading short-term pain for long-term survival.
Bassett is operating under this really fascinating tension right now because, on one hand, they're taking hits from external shocks that are totally out of their control. We're talking bizarre weather, housing market freezes, global supply chain tariffs.
Just a perfect storm of problems.
Exactly. But instead of going into survival mode and freezing their budgets, they are doing the exact opposite. They're aggressively spending millions to modernize their technology and buy up new physical real estate.
I want to start by looking at that baseline reality they're operating in, though, because the immediate Q1 financial numbers paint a picture of a company walking face first into a massive headwind.
Oh, absolutely.
Total sales came in around $80.3 million, which is a drop of about 2.2%. Their earnings per share missed expectations by 6 cents, and operating income fell to $1.2 million. So, okay, let's unpack this. Why did those numbers dip so hard?
To really understand that, you have to look at three distinct external forces that just drag them down. The foundational issue, the really big one, is the residential housing market. It has been stubbornly weak.
Right, because nobody's moving.
Right. The underlying mechanism here is that furniture sales are intimately tied to real estate turnover. When a family buys a new house, they almost always buy new furniture to fill it. Maybe a new dining room set for a larger space, or a new custom sectional for the basement.
So when high interest rates cause people to just stay put in their current homes, the downstream effect is that nobody actually needs to buy that new dining room table.
Precisely. Housing transactions freeze, which freezes major home furnishing purchases. But, housing was just the slow-moving macro problem. The second force was an acute physical shock.
The weather.
Yes. In mid-January, severe winter weather completely shut down over 50% of Bassett's retail fleet during one single weekend.
Ow.
And then, the very next weekend, another storm closed 25% of their locations.
I feel like a lot of people might think, so what? If a customer wants a couch on Saturday and it snows, they just go buy it the following Tuesday, right?
That is the logical assumption, yeah.
Yeah.
But retail psychology doesn't actually work that way, especially for high-ticket items. Furniture buying is a highly weekend-dependent activity.
That makes sense. It's a big decision.
Exactly. It requires both partners to be off work. It takes a few hours of browsing, sitting on different fabrics, maybe consulting with a designer. Nobody is doing that on a Wednesday morning before their Zoom meetings.
Right.
So when you lose 2 consecutive weekends in January, which, by the way, is historically a massive post-holiday sales period, management noted those become lost sales, not deferred sales. Lost. The moment passes, the consumer gets distracted, or that money just goes toward a different expense entirely.
A literal blizzard kept them out of the stores. So, consumers aren't moving to new houses and they can't get to the showroom. But let's talk about the third hit to their quarter, because this is where that deliberate financial sacrifice we talked about comes in. Their retail gross margins took a 170 basis point dive.
Which means their gross profit margin dropped by 1.7%.
That sounds small, but it's not, is it?
No, not at all. In a business with high overhead costs like manufacturing custom upholstery and running massive retail showrooms, losing nearly 2% off your margin overnight is a huge chunk of expected cash simply vanishing.
And the reason why is this invisible blizzard of tariffs.
The timeline of these tariffs really dictates everything here. Let's look at the mechanics. Bassett had already implemented a price increase for their wholesale and retail customers back in July of the previous year just to combat rising costs.
Okay.
Then, in the fall, a totally new wave of tariff adjustments hit the industry. Management looked at this new expense and realized that if they hit their customers with a second price hike within a 60-day window, it would shatter consumer trust.
I mean, yeah, you nickel and dime a customer twice in 2 months, and they will absolutely just walk across the street to a competitor.
That was exactly the fear. So Bassett made the strategic choice to eat the cost of those new tariffs for any goods sold in the fourth quarter.
It just absorbed it.
They absorbed it. Now, because Bassett specializes in custom furniture, they usually don't even start building a piece until the customer places a deposit. That creates a 4 to 5 week lag between the day the sale is made and the day the furniture is actually delivered and the revenue is fully realized.
Oh, I see. So they absorbed the tariff hit on all those late-year orders to protect their sales volume. But because of that manufacturing lag, the financial pain of that decision didn't show up on the balance sheet until Q1.
You nailed it. That's exactly what dragged their margins down so hard in this recent quarter. By mid-January, they were finally able to bake those new tariff costs into the retail pricing for new orders going forward. But they willingly took that margin hit in Q1 to preserve the grown relationship.
So, okay, physical stores were frozen, housing is stalled, and margins got chewed up by absorbing tariffs. I know you're probably wondering, how did their digital storefront perform through all this? Because this is where the strategy starts to show some serious return on investment.
It really is the bright spot of the report.
Despite the physical slowdown, their digital sales are booming right now.
The numbers are stark. Late in 2023, Bassett launched a completely overhauled web platform, and in this tough Q1 environment, their web conversions skyrocketed by 130%.
That is massive.
It is. That resulted in a 28% increase in online orders, and the actual delivered web sales were up 46%.
Wait, hold on. I have to challenge this premise a little bit. We are talking about a brand built on something they call true custom upholstery.
Right.
People are dropping $5,000, $6,000, maybe $7,000 on a custom sectional entirely from their iPhone. I feel like I need to physically sit on a cushion and touch the fabric before I make that kind of commitment.
Yeah, you and me both.
How does an e-commerce approach actually work for luxury furniture? The return rates alone would bankrupt them if people don't like how the couch feels when it finally arrives.
Your skepticism is shared by basically every legacy furniture executive for the last decade. But the way Bassett is utilizing their digital platform isn't about replacing the physical store. It's about creating a seamless omni-channel funnel. The website is now the front door to the brand.
Okay, what does that mean in practice?
It means customers are spending significantly more time on the new site, using digital tools to design their pieces, swap out fabrics, and visualize the dimensions in their actual living rooms.
So they do all the heavy lifting and research at home on the iPad.
Yes. And for a certain demographic, particularly the younger, higher income earners Bassett is targeting, they are entirely comfortable hitting buy online, especially since Bassett recently rolled out a national home delivery network to areas where they don't even have a physical store.
Oh, wow. That changes things.
It does. But for the majority of buyers, that deep digital research creates highly qualified foot traffic. By the time that customer actually walks into a physical store, they aren't just browsing. They already know exactly what they want.
They just need to do the sit test.
Exactly. They verify the fabric texture and finalize the transaction with a design consultant. The digital ecosystem acts as a massive net that just feeds the physical locations.
Which means we need to talk about their physical footprint strategy, because digital growth is vital, obviously, but Bassett's DNA is physical space. On this earnings call, CEO Rob Spillman laid out an aggressive 5-point blueprint for future revenue. They aren't retreating into the internet, they are expanding their real estate.
Yeah, they are balancing their legacy strengths with these new market realities. The first pillar of their physical strategy is driving growth at their existing comparable stores. Even in this brutal quarter, their true custom upholstery segment saw a 6% increase in retail written sales.
That's impressive given the weather issues.
Yeah.
Very, and they're constantly introducing new lines to keep consumers engaged, like the Z4 Sleeper and the Hideaway Dining programs.
But the really fascinating part of their physical strategy to me is how they're approaching new store expansion. They are building some new corporate stores from scratch in places like Cincinnati and Orlando. But, I mean, retail rents and commercial construction costs have just skyrocketed since the pandemic.
Oh, they're astronomical. Building a massive new furniture showroom is incredibly expensive, and it takes up to 2 years.
Right, which is why their strategy for acquiring existing stores is so brilliant. They are aggressively converting licensed stores, which are independently owned but sell Bassett products, into corporate-owned locations. They just did this with several stores in the greater Philadelphia market.
It's a really smart play.
Let's pause and really look at why this is happening.
Yep.
Because there is a mind-blowing demographic shift happening in the furniture industry right now. You have all these independent mom-and-pop retail operators who opened their stores in the 80s and 90s. They're reaching retirement age.
But they have no succession plans. Their kids went off to work in tech or finance or whatever, and nobody wants to take over the grueling family business of selling dining room tables.
It's a massive generational transition. A 65-year-old independent operator wants to retire, but they can't find a buyer for the business. Normally, that store would just liquidate its inventory, close its doors forever, and a local market would lose a major furniture retailer.
But instead, Bassett swoops in. They buy out the retiring owner, take over the lease, and convert it into a corporate Bassett store. They are essentially gobbling up existing market share and fully staffed real estate just by being one of the last legacy players standing with enough capital to make the purchase.
It is a phenomenal consolidation play. You bypass the 2-year construction timeline, you avoid the skyrocketing costs of building new shell, and you instantly acquire a location that already has a built-in customer base. It's plug and play.
Okay, so that handles the large 15,000 square foot showrooms. But what about getting their brand into smaller markets where a giant store just doesn't make financial sense?
That leads to another major pillar of their physical expansion, which is the custom studio concept. Typically, Bassett operates full design centers, which are 3,000 to 5,000 square foot dedicated spaces inside independent dealers. But the custom studio is completely different.
How so?
It's only 1,000 square feet. It focuses exclusively on the custom upholstery program, and crucially, it requires zero inventory from the independent dealer holding the space.
That is a brilliant retail Trojan horse. I mean, think about the mechanics of this. You approach an independent multi-line furniture store in a mid-sized town. You offer to drop a tiny, beautifully designed 1,000 square foot pad right into the middle of their showroom.
Right.
The dealer doesn't have to buy a bunch of couches to stock it. Bassett handles the custom manufacturing with a short turnaround time. It allows these independent dealers to test the waters and sell a premium brand with almost zero financial risk.
And once it proves successful and starts generating real revenue for both the dealer and Bassett, they can upgrade that location to a full 3,000 square foot design center. They have actually opened 60 of these custom studios in just 2 years.
Wow, 60?
Yeah, and they recently upgraded 3 of their best performers. It's a low-risk, high-reward beachhead into entirely new geographic markets.
So they're capturing the mom-and-pop real estate, they're deploying these Trojan horse studios, and they are also pivoting hard into commercial real estate with a new Bassett hospitality division.
The hospitality push is pure diversification. If the residential housing market is weak and families aren't buying couches, you pivot. You start selling 50 beds and dressers at a time to a new hotel or a senior living facility.
Makes total sense.
Bassett already has a massive domestic manufacturing infrastructure in place, including a huge presence in domestic aluminum for outdoor furniture. So they're simply leveraging that existing supply chain to target contract business.
And to support this, they are heavily renovating their wholesale showroom in High Point, North Carolina, specifically tailoring it to attract professional interior designers and commercial contractors.
Right, it's a totally different sales motion, but the margins can be fantastic.
Which brings us to the most critical question of the entire deep dive. Expansion and growth sound fantastic when a CEO pitches them on an earnings call. But how does Bassett actually protect its bottom line and pay for all of this?
That is the million-dollar question.
Building new stores in Orlando? Renovating wholesale showrooms? Rolling out e-commerce platforms? That takes massive amounts of cash, especially at a time when global supply chains and inflation are squeezing every single dollar.
It all comes down to liquidity. Fundamentally, Bassett is operating from a position of financial strength. They have $51 million in cash and short-term investments, specifically certificates of deposit.
Okay, that's a nice safety net.
It is, and because they have that cash cushion sitting there, they are actually doubling down. They are bumping their capital expenditures. You know, the money used to acquire or upgrade physical assets up to between $8 and $12 million for the year. Compare that to the $4.5 million they spent last year.
But they are finding ways to balance that spending, right? Management mentioned they're implementing operational cuts to save $1.5 to $2 million annually, which starts taking effect late in the second quarter.
Yes, They're trimming the fat where they can.
And despite the tough Q1 numbers, they maintained their 20-cent dividend and even spent a little money on opportunistic share buybacks.
Maintaining the dividend is crucial. It signals confidence to the shareholders that the long-term plan is intact and the company isn't panicking. But we do need to look at the macro squeeze, because the inflationary pressures threatening that cash pile are very real and very immediate.
So what does this all mean? Let's talk about the freight situation first. Management specifically called out surcharges from their shipping partner, J.B. Hunt.
Right, so Bassett has what's called a captive freight situation with J.B. Hunt, meaning they rely on them heavily for logistics. Right now, they are receiving weekly freight surcharges that fluctuate directly with the price of diesel fuel. Weekly. So if diesel spikes, Bassett's cost to move a couch from a factory in Virginia to a home in Texas spikes immediately.
And the inflation isn't just in the trucks delivering the couches, it's baked into the raw materials inside the couches. Petroleum derivative products, things like the foam and the poly used to make upholstery cushions, are seeing significant price increases from suppliers.
And management stated flat out on the call that those specific material increases are going to be passed on to the customer soon.
Which creates an incredible tension with the strategy we discussed earlier.
It does.
This is exactly my point of pushback here. I have to challenge this pricing logic. They absorbed tariff costs in Q4 to protect their relationship with the customer, and that crushed their Q1 margin. Now they finally baked those tariffs into the price, and soon they're going to pass on new foam and fuel surcharges too.
Yeah, the price tag is going up.
At what point does the consumer just hack out? You can only raise the price of a custom sectional so many times before a family decides, you know what, their old couch is perfectly fine.
If we connect this to the bigger picture, you are highlighting the most delicate balancing act in retail right now: price elasticity. In a high-end retail environment during a housing slump, how far can you push the consumer?
Right.
The underlying logic for Bassett is that their target customer is generally higher income, and a higher income earner is slightly more insulated from day-to-day inflation than a middle-income consumer. They might complain about the price of groceries, sure, but they still have the disposable income for a luxury purchase.
But they aren't immune to sticker shock. I mean, nobody likes feeling like they're being ripped off.
No, they aren't. That is why Bassett is leaning so heavily into the perceived value of the brand. They are betting that their core demographic will accept a price increase if the service remains exceptionally high. If you are getting free in-home design consultations, a seamless digital design tool, and high-quality domestic manufacturing, the customer is more likely to swallow a 5% price increase. It's a calculated risk.
We also have to address the global supply chain because during the Q&A portion of the earnings call, financial analysts really zeroed in on global tensions, specifically the conflicts in Ukraine and the Middle East.
Yeah, and looking strictly at the economic impact of those situations, management noted a very specific vulnerability. Their raw materials and imported goods from India must travel through the Strait of Hormuz. Analysts wanted to know if the geopolitical tension there was causing shipping costs to just explode.
But the answer was surprisingly counterintuitive.
It really was. Management explained that they haven't seen a massive spike in container shipping prices yet. And the reason why is rooted in the broader global economy. Basically, overall global demand for consumer goods has been incredibly tepid.
Oh, because people aren't buying as much stuff.
Exactly. Because consumers worldwide are buying less stuff, there is less competition for space on cargo ships. That lack of demand has kept shipping capacity relatively open, which actually prevents a price explosion.
So a sluggish global economy is actually acting as a temporary shield against supply chain inflation. That's wild. It is an incredibly volatile situation that clearly requires daily monitoring. You have weather freezing your stores, housing markets locking up your core demographic, tariffs squeezing your margins, and global shipping routes threatening your raw materials.
That's a lot.
And amidst all of that, you are actively trying to build new corporate stores, launch web platforms, and pivot into commercial hotel furniture.
It requires an immense amount of corporate discipline. They are managing the daily crises while absolutely refusing to abandon their 10-year vision.
To bring this all together, Bassett is really a prime example of a legacy giant choosing to take a beating in the short term. They absorbed the margin pain from tariffs, and they fought through frozen weekends, all so they could keep funneling cash into their strategic positioning. They are betting that their e-commerce investments, their commercial hospitality push, and their physical store expansions will pay huge dividends when the macroeconomic storm finally breaks and the housing market normalizes.
They have been navigating these kinds of market cycles for 124 years. This entire strategy is basically a bet on their own endurance.
Before we wrap up, there is a larger industry question I want to leave you with.
Yeah.
Something for you to mull over the next time you drive past a local retail strip mall. We spent a lot of time analyzing those independent mom-and-pop furniture operators retiring without any succession plans, and how Bassett is buying up their stores.
It is a quiet revolution happening right under our noses, and it extends far beyond just furniture.
It does. As that generational trend accelerates across the country, in hardware stores, in clothing boutiques, in local specialty goods, will legacy corporate giants naturally inherit the entire physical retail landscape by default. Not necessarily because they have better products, but simply because they're the only ones left with enough capital to absorb and convert those empty spaces. It really makes you wonder what the future of local business looks like. Thank you for joining us on this deep dive. Keep questioning the forces shaping the businesses around you. The next time you sit on a custom couch, you'll know exactly how many global and economic gears had to turn just to get it into your living room. Until next time.